We're going to take a look at issuing a note payable. So in our example here, on September 1st, we purchased equipment for $60,000 and issued a 6-month 11% note payable. So on September 1st, we would debit equipment and credit notes payable for the $60,000. Now, if we issue the note and pay for it in the same period, we can just wait until the maturity date when we pay the interest to record the interest expense. However, when you issue the note in one period and then you don't pay for it to the next accounting period, you have to make a year-end accrual to accrue the interest expense on that note. So that's what's happening here. Our year ends on December 31st. And really, every day that's going by on this note, we're incurring interest expense. So if we wait until the maturity date on March 1st of next year to record the interest expense, all of that interest expense is going to be reported in 2019, when a portion of it was incurred in 2018, and we need to make an adjusting entry to get it recorded. So what we need to do on December 31st is we have to debit interest expense. And the calculation for the interest expense is going to be the principal, $60,000, times the rate, 11%, and then times the time, because $60,000 times 11% will give you a whole year of interest, because 11% is the annual rate. We're not paying a whole year, we're paying interest for September, October, November, and December, so 4 months. So we'll go 4 divided by 12, and that'll give us the interest expense. Now, we're not paying that interest expense on December 31st. It's not going to get paid until the maturity date next year, 2019, March 1st. So as of December 31st, we owe the interest. So we're going to credit interest payable for $2,200. Then when it comes time for the maturity date on March 1st, we're going to pay off the note, but we also have to pay interest on the note. So since we're paying the note, we'll debit notes payable for $60,000. We'll credit cash for the cash that we're paying. And we're not just paying the $60,000, we also have to pay the interest. So the interest for our 6 months is calculated as the $60,000 times the 11% times 6 divided by 12, right? Because we're paying for 6 months. So the interest is going to be $3,300. So the cash payment is going to be $63,300. Now, part of this $63,300 was interest expense that we had incurred in 2018, and we recorded it in our adjusting entry. We recorded $2,200 as interest expense, and then we set up a liability of $2,200. Well, what's happening here is we're paying off that liability. When we pay the $63,300, we're paying off that $2,200 we said we owed at the end of 2018. So we'll have to debit the interest payable for $2,200. And then finally, we have to record the interest expense for what we have incurred in 2019. And so what we've incurred is the $60,000 times the 11%. And again, that gives you a whole year, but we have only incurred interest for January and February, right? Because we accrued through December 31st when we were making our 2018 entry. So now we're just recording the January and February interest expense. So we go 2 divided by 12. And that gives us $1,100. And so we can see that adds up to $63,300. Debits equal credits. And so that's how you record a note when there's accrual of interest.